Hi, welcome to Chapter 16, Estate Planning. So in this chapter, we're going to talk about what estate planning is and why it's an important process and what estate taxes are. We're also going to talk about how to draft up a will and what's involved in a will and its purpose in estate planning and how to avoid probate. Okay, so introduction. What is estate planning? Estate planning is something most people don't like to deal with, talk about, think about, or work on because it involves death. So you're planning to what's going to happen to your money and your wealth uh, after you die, and which of your dependents or inheritors are going to get your wealth. So you want to it's sort of like a game. You want to strategize so you can pass along as much of your wealth as possible while minimizing the taxes and the transfer costs. So you also need to determine who has the decision-making authority if you're incapacitated, meaning that you can't make decisions. So this is all stuff that is uncomfortable to think about or talk about, and that's why a lot of people don't have a power of attorney set up, don't have a will, don't have an estate plan, and then if they when they pass, all hell breaks loose. You know. Okay. So the first step in estate planning is to determine the value of your estate, and that's really just seeing how much money is in your estate minus any liabilities. So you might have two or three homes, but you have to minus whatever's left on the mortgages on those homes to get the additional value to your estate. What's in any bank accounts or any um, brokerage accounts or any collectibles or artifacts that you might own. These all become part of your estimation of your net worth. Then you have to choose um, who do you feel should inherit your wealth. So who's going to get it? Now, a lot of the laws are in favor of a spouse, but you might have dependents that you want to leave money to, or you might have relatives or friends. And if you don't specifically outline who these are and how much they get, they will get nothing. So you want to determine also the cash needs of the estate. So before disputing any property to your heirs, the state must pay for any medical costs, funeral expenses, legal fees, outstanding debts, the state inheritance taxes. So you must make sure that the state can pay for all the obligations before you hand out all the money. So liquid funds should be usually used, mean money in a bank account usually, to cover these state tax needs. So you don't want to promise uh, any money or property to people unless the state can settle all of the obligations of the properties. Step 4. Uh, Select and input your estate planning techniques. So decide which estate planning tools are that you're going to use that's going to meet your goals. And the most common for most people is a will, a power of attorney, joint ownership, trusts, life insurance, and gifts. So this is the most common areas or techniques of ways to manage your estate. Now, the reason we have to manage our estate is because the U.S. government is very aggressive in taxing people's estates. Now, the way I feel about it, and a lot of people feel about it, is that you already paid tax on the money you earned, and you took that money and you placed that into assets and bank accounts and stocks and houses. Why should you pay tax on it again when you die? So that's not fair. But the US government feels that it's necessary. Now, some of it, because they can see the point for most people who have, say, under $5 million, you shouldn't be taxed. So this is meant to be more of a tax on the wealthy. So the idea is if you're Bill Gates and you have $100 billion estate, that a lot of the support from the U.S. government, education, technological developments, helped and aided you in gaining all that money, and some of it should be paid back to the government based on all the public services that you use. For example, Microsoft hires a lot of employees. These employees went through public school and had certain government assistance. So a lot of the thinking is a lot of that wealth wasn't generated solely by the individual, but the US government and its public works supported it, such as infrastructure. And, for example, Bill Gates, most of his money came from Microsoft, which made a great deal of money, and much of that is due to the fact of the internet. So with the government developed the internet, so without the internet, Microsoft wouldn't have been as profitable or powerful as it is today. Just an example. So anyway, there is a tax credit that, as of 2017, is 5.49 million. This changes every year, so this is not what it is today. It's adjusted for inflation. Um, this is the amount of estate that can be tax free. So if you have under, you know, $5 or $6 million, you don't have to worry so much about um, the government high overtaxing your estate, because you do get this unified tax credit. So anything above that 5 million, 5, 6 million or so is going to be taxed at a 40% estate tax rate. Um, so that is pretty aggressive. Uh, so yes, so say you did have $10 million, which isn't impossible. I think you'd be surprised at how many people in your life are millionaires and you don't even know it. For example, your parents may be billionaires, or probably are millionaires. You don't even know it. I mean, if you're living in a house that your parents own, that house could be worth $600,000, 700,000, plus whatever bonds or stocks or retirement plans they have. You'd be surprised how much money people accumulate. But anyway, if you did wind up in a situation where you had $10 million, you would want to aggressively do some estate planning, because of the portion of the money that's not covered by this unified tax credit, you're going to have to pay taxes on that, or your heirs will, at a 40% rate, which is pretty aggressive. Now, the estate tax exemption is portable, and what they mean by that is if you're married and your spouse dies, then the surviving spouse gets any residual. So if you die and there was only, you could only use 2 million of this unified tax credit, the remainder would be added to your wife or husband's or partner's um, tax credit. So if they have a 5.4 million dollar tax credit, um, so that extra 3 million would be added to them. So basically, think as a couple, as a married couple, you're really more like 11 or 12 million dollars unified tax exempt credit, but just depends on the timing of it. But the one thing you can't do is if one person dies, um, the portion that the living spouse has can't be transferred to the portion for the person who died first. That is going to be capped at the 5.49. Now, calculate what your estate tax will be. So, to calculate your estate tax, um, this is a whole process where you're going to go through, determine your gross estate, then the taxable portion, and then you adjust for any taxable gift. I'm sorry, pre-tax gifts, and then you can calculate your estate taxes. So really, just saying what portion is untaxable due to credits and gifts, and what portions do you have to pay tax on. Now, as speaking of gifts, so what a gift is when you're alive, you're allowed to give, as far as what was stated in 2017 has changed today. You're allowed to give $14,000 tax free um, to really anybody you want. So it's a gift, but you can't do more than $14,000 per person. Now, the total gift tax and the estate tax work together with a total lifetime exemption of 5.49 million on gifts over the $14,000 per recipient. So if you give someone 50,000, anything over the 14,000 would be put into that $5.49 million one-time tax exemption. So this is a good way for it's a good way for you to, if say you're alive, which if you're listening to this, you most likely are, and you have a lot of money, and you know that probably you estimate that maybe you have 10, 15 more years to live, but you have $1 billion. And you know that a lot of that's going to be taxed. So you can start giving money to your inheritors or family or friends now as gifts. And that's going to reduce the taxable estate because it reduces the overall value of estate when you give this money away. Um, so you're allowed to give that 14,000 tax free to as many different people as you like. So that's a way to, reduce your overall tax burden by giving the money away now, which is a pretty a generous thing to do, and it's a lot of people do take advantage of that. So you might have been a recipient of this if you have some grandparents and they have a lot of money and they know about this, and they every year they might gift you and your parents $14,000 because they can do that without having any taxes being paid to the government, which is a really good way of dispersing that income. And then it's also nice for them to see people being able to use this income while they're alive and appreciate the gift from, say thank you and stuff. So it's a pretty cool thing all around. So unlimited marital deductions. So unlike the 5.49 threshold for other beneficiaries, there's no limit to the size of the estate can be transferred tax-free between a spouse. And it's one of the benefits of being married is that if you're married, and it's one of the reasons when people die, they leave most everything to their spouse, is because it's going to be 100% tax-free basis, as long as the spouse is a U.S. citizen. So that unlimited marital deduction uh, for gift and estate tax purposes, that means there's, and it could be $1 billion and it goes from the husband, say, to the wife, in many cases. The So regardless of the size, it's totally tax free. And that's why you notice that for a lot of people's wills or a lot of laws are written in favor of whatever the estate is to go, to the spouse, and that gets transferred, tax free. So it's a really good loophole to be in. Now, there's also this generation skipping tax. So this is an additional tax imposed on gifts and bequests that skip a generation. So for example, gifts that pass assets from the grandparent to the grandchild. And the purpose of this generation skipping tax is potentially make sure the lost tax dollars from the intervening generation. So in effect, the assets are taxed if they're moving from grandparent to their own children, and then their children to their grandchildren. So it's a tax on wealth and property transfers to persons that are two or more generations younger than the donor. So it's an additional tax, and that's why generally it's better if somebody dies, they leave the money to the spouse, number one, or directly to their children. So, and that's why for grandchildren, it's best to do that $14,000 gift every year to avoid this additional tax. Okay, so calculating your estate taxes. Now, this is something I was talking about before, but basically you want to, there's think of these as four steps. So you want to calculate your gross estate, and this is the value of assets and property. And it's going to include the proceeds of life insurance and pension plans, collectibles and investments, in addition to the value of other assets owned at the time of the death. So you want to figure out what is the gross size of the estate, the total value of the estate. And then your taxable estate is equivalent to your gross estate less any funeral and administration expenses, any debts, any liabilities or mortgages, any marital or charitable deductions. So then, so basically these are like your exemptions. So you take your total size of your estate, and then you have to deduct these liabilities and costs. And, and then, so before calculating your estate taxes, you have to calculate your taxable lifetime gifts, and they must be added to your taxable estate. So as in calculation two, step two, the estate tax-free transfer threshold, you know, is 5.49 million. So you have to really see take away that 5.49 million, and this will give you the remainder. So the remainder will be the estate taxes that will be calculated, and multiply your adjusted taxable estate that we calculated in step 3, and then it's going to be a 40% rate. This is as of 2017. This may have changed by now. And that's the taxes that will be imposed on your estate. So you can see that for most people, they don't have to worry too much about estate tax, because they're going to have, after their 5.49 um, tax-free deduction, they're not going to have any money left over to be taxed. So this is a tax that really affects the wealthy. And that's why a lot of people also, here's the 4 steps laid out. A lot of people also don't worry about estate planning as much because they don't have a lot of money. Okay, that's not to say you shouldn't have a will, but some of the tax burden you may not have to worry about if you're not very wealthy. And this is just an example of, you put your gross value of estate, you minus any of your expenses, so you get your total expenses, so you have your taxable estate here, and then any cumulative lifetime gifts that you want to add to that that amount. This is gifts over the 14,000, then per person per year, and then you want to less the tax-free transfer threshold, so then you get your adjustable, what the position left over that's taxable, and then that you pay 40% tax on that. Okay, now most people, a lot of people, not want to say most, but I'll say a lot of people, by the time, remember this $5.49 million threshold increases every year and is tied to inflation. So chances are, by the time you retire, you may not have to worry too much about estate tax. Um, However, you still would want to worry about who gets what. So that's what a will is for. A will is a document that's going to describe how you want your property to be transferred to others. Do you want everything to go to your spouse, or do you want somebody to go to your children? Maybe you have children from a previous marriage. Maybe you have some close friends. Maybe you even have some parents. So this will is going to dictate who that's going to go to. Now, generally, beneficiaries are individuals who are named or willed in the property. So the executor is going to be the person responsible for carrying out these provisions. Or guardian. So guardianship is someone who will take care of children that is under 18. So these are things that you want to list out in your will. Now, when you have a will, sometimes it can be challenged. And there's going to be a probate, which is going to be a legal procedure to validate the will and to distribute the assets. So the advantage is the probate allows for challenges to be settled. So once the probate is finished, the will is done, and generally you can't challenge it after that point, most times. And the probate allows for the distribution of assets after they die. So if you don't have a will, you have to go through probate anyway. Disadvantages is that it's very costly and it's slow. Now, if there's no will, then that's the worst thing possible. So, and basically, unless you have $100,000 or more of assets, a will isn't that important. So right now, if you only have $20,000 in assets in the bank account, you don't need a will. You just take that bank account and put a direct beneficiary on it. Just go to the bank and put, your direct beneficiary on the account. Same thing for your retirement accounts, your brokerage accounts. So you can just set that up so they'll get the money upon your death. No will or probate court is needed. So there are ways that if you don't have a will, you can set beneficiaries up in your life insurance policies and your bank accounts and your brokerage accounts. You can set up joint ownership for, let's say, your home. You could have a title with 2 names on it. So there are other things that you can do to ensure that the assets are going to quickly transfer to the beneficiaries with no will is needed. So a will would probably be needed once you have more significant amount of assets that are in some sort of phase where you're not able to add a beneficiary to them, such as like artwork. But if you do have children, it's very important to have a will as soon as you have children because you want to decide the guardianship of your children and you don't want the court to decide that. Now, a um, will also lay out the appropriate money that will be needed for the children's, say, education, or if they have special needs, you can specify how much money will go to that particular purpose. The property will be transferred according to your wishes. Um, you can make gifts as well through your will. You can donate to charities through your will. But without a will, a court administrator will distribute your assets, which could be costly, and your assets could be going to people that you don't necessarily want them to have. Okay, so when you write a will, they have these particular segments of the will. And for writing a will, you could write your own. Not a good idea because handwritten wills or oral wills or typed out wills are definitely more challengeable in court. So it's better if you have a lawyer walking you through a boilerplate of um, a will to make sure everything is, all the legal terms are properly spelled out. But basically, when you're writing a will, you're going to have your introductory statement, which is going to identify that the will is going to revoke any prior wills, that this is the latest will, and that there isn't any conflicts, and you're going to um, just state that what your intentions are. Uh, and then the second clause will be the payment of debt and taxes clause. So this clause would be allow for the direct payment of any debts upon the death, funeral expenses, and taxes. Then the distribution of property clause, and this clause will allow for distribution of money and property in the states who receives what and what happens to the remainder of the state after all the bequests have been honored. Then you have the appointment clause, and this clause it names the executive of the state and the guardianship of any children under 18. Then you have the common disaster clause, and this is if, um, for example, which your spouse, you know, is assumed to have died first in the event that both die simultaneously. That could have a factor on how the assets are disputed or distributed. And then you have the witness clause, and this is where you have people witness that you're signing it and they validate. Usually, notary, a republic has to witness it as well, and this helps to prevent it from being challenged. That they don't. The idea is that if you don't want somebody else making up a will and saying it was yours so they can get most of the money. Now, um, after you finish your will, you may want to add an attachment that alters or amends a portion of the will. And this can be drawn up by a lawyer, witnessed, and attached to the will. So sometimes you create a will and then 10 years go by and different relatives die or different friends you separate or you may get divorced and remarried and wills need to be updated. So you can update a will, and it's just an amendment to the will at the end of the will. Okay, so the last part is a letter of instructions. So this is something often dramatized on TV where there's a video and the person tells everybody how they feel or what, instructions. So generally to the surviving relatives, mostly to the spouse, I would say, and it provides information and directions with respect to how the will should be uh, executed and any last statements they want to make. Now, so it's just a last chance, I guess, to say goodbye or state your wishes, or also, um, more importantly, to give the location of where the legal documents are: birth certificates, social security cards, passports, tax returns, the location of different financial assets, where are your bank accounts, your brokerage accounts, what the account numbers are. Um, it can just give instructions to make it easier for the people who are surviving to be able to know where all the financial documents are, who they should notify, where all the personal properties, any funeral or burial instructions, things of that nature. So pretty important piece. I mean, it's not it's not really dealing with the nitty gritty of the money and where everything's going. That's stated elsewhere in the will, but this is really just, okay, here's what you should go about doing after I die. There could be instructions about how you want your ashes spread and where you want your ashes spread. You know, now, selecting an executor. So this is someone who's going to make sure your wishes are carried out, who's going to manage your properties until they're inherited by your heirs. This could be a family member, a lawyer, a bank trust officer, a close friend, and it's going to deal with personal matters, paying taxes, paying off your remaining liabilities, distributing the what remains of your wealth, and making sure that the will is honored and to the best of their ability. So it's an important person, someone you really trust, and someone that you would have figure would do the best for you. Okay, and then finally they're going to report the final accounting to the courts at the end of distributing all your properties, remaining properties. Okay, so other important estate planning documents. You have the durable power of attorney, which basically will grant someone the power to sign legal documents in case you become mentally incapacitated, such as you're in a coma. Um, so living will allows your state the wishes regarding your medical treatment in the event of your illness or injury, whether to pull the plug or not pull the plug or resuscitate. So um, that's an important document. And related to that is the durable healthcare power of attorney designates someone to make your healthcare decisions, and that's a person who's actually going to pull the plug or not pull the plug. So it's important. Make sure that's an important person that you spell out. Um, Now, as far as avoiding probate, since probate is just like a nightmare and it's long and it takes a long time for your relatives to get their assets and get their money, and it can be challenged, it can be messy. So, to avoid the probate, a lot of richer people who can afford good lawyers, they're going to advise you get a trust. But before you get a trust, you can also do a joint ownership. So if you have a joint bank account, no probate necessary. That money goes directly to the survivor of the account. If you have two names on a mortgage, if you have, or even if you have beneficiaries on your financial accounts, that helps avoid any probate discussion. And there's also gifts. So gifts are going to be outside of probate, and they're not really challengeable since they're made earlier. And then now we get to the trusts. So, well, let's just take a step back here. To joint ownership, um, so these are survivor rights. Any joint account is common property, or if you're in a marriage, there is common property. So this is something that is pretty well established, and it's not anything that's going to be easily challenged. So now there's basically something called joint tenancy with the right of survivorship, where there's two or more individuals share the ownership of the asset. And so, like a joint bank account or joint brokerage account. Um, Now, with tenancy in common, two or more individuals share ownership of the assets. So when the owner dies, the owner's share becomes part of his or her estate, is distributed according to his or her will. So that's a whole nother entirety. So there could be some nuances in that joint ownership that you should know about. Now, as far as common property or community property, um, this represents another form of joint ownership where community property is any property acquired during a marriage, assuming that both husband and wife share equally in the ownership of those assets um, acquired through marriage. And so it doesn't include assets each spouse owned individually prior to the marriage. So is it property that was generated, wealth and property generated during the marriage or outside of the marriage? That's an important distinction to make. Gifts, as we talked about before, they're going to avoid probate. It's a good way to transfer money. So unlimited gift tax exclusions to charities if you want to give to charities. So um, now, the problem is if one drawback of gifts is if you do give gifts, you can't take them back. So if you're giving out gifts to charity or family members or friends when you're alive, and you need those funds later on in life, they won't be there, and chances are they won't be given back. So that's why a lot of people are oftentimes afraid to give too much gifting too quickly because they don't want to run out their own funds to live off of. Okay, so naming beneficiaries in contracts, life insurance, or retirement plans. This is going to avoid probate by naming beneficiaries directly in on your bank accounts, on your retirement accounts, on your life insurance policies. So this is just, you've already stated, I opened up this bank account. If I die, it goes to this person. No questions asked, no probate. It's a very easy way to transfer assets between people. And it should always be set up regardless of if you have a will or don't have a will. This is the first line of protection. And it's going to avoid the probate because you're directly naming your beneficiaries on specific assets. So it should always be set up. Now, moving on to trusts, a trust is another level of complexity that you need a lawyer to set up. That's going to be relatively, compared to wills, it's going to be a lot more expensive to set up, but it has more benefits. So a trust is a legal entity that's going to hold and manage assets for another person. So it is created when a grantor transfers property to a trustee for the benefit of one or more beneficiaries. And a trustee can be an individual, an investment bank, or a regular bank or investment firm. So any asset can be placed inside of a trust: a house, money, collectible artwork, baseball cards, whatever. The advantages to trust is that it's going to avoid probate. They're private, probate can't touch it. It's more difficult for anybody to challenge these trusts in court, so it's a lot more stable and bulletproof of a legal entity that you set up when you're alive, and it directly notes that you took the action to sign the documents to hire a lawyer to create this trust as your intention when you were alive. It's going to reduce estate taxes because the trusts in most cases can't be taxed. It allows for, um, although income a trust generates can be taxed, and it depends on the type of trust. So we'll get to that later. So it allows for professional management of your assets. It's going to provide confidentiality because wills are public, trusts are not. It provides for children with special needs. It holds money until the child reaches maturity if you have children under 18. And it can also ensure children from previous marriages receive some inheritance, which typically can get cut out when you're remarried. So there are two types of trust. So there's a living trust, which is a trust which you place your assets in while you're alive. And there are two types of living trusts. There's a revocable living trust where you place your assets into the trust while you're alive, and you can withdraw funds from the trust later if you wish. So it's an alternative way to hold your assets. So you can put things like your bank accounts and your house can be in the revocable trust, and you have access to them. And you can receive income from them, and you can use them, uh, and, um, and you can pay tax on whatever income these assets generate. So you're in control of these assets in the trust, and you're going to receive. So it's basically puts you a higher amount of control. Now, so when we're just talking about the revocable trust, the advantages are, of course, you avoid probate legal wrangling when you die. It's just easily transferring the ownership. Um, you maintain the power to alter or cancel the trust. If you become incompetent, your trust will be professionally managed by who you designate, uh, and you can replace a trustee at any time if you don't. Now, the disadvantage is there's no tax advantage. You pay tax on any income or any capital that the trust is going to generate. Um, the assets in the revocable living trust are considered to be part of your estate for state taxing purposes, and the assets in the revocable living trust cannot be used as collateral for a loan. So those are the advantages and disadvantages. Now we get to the irrevocable trusts. So these are trusts that you're going to relinquish your ownership, some of your ownership rights, control these assets when they're placed in this irrevocable trust, which means that um, you have less control once this trust is set up. But the advantages are the assets in trust avoid probate, just like the revocable trust. Any price appreciation on your homes, on your stocks, is not considered part of your personal estate. So there's no estate tax imposed on the irrevocable trust when you die. income earned from these assets trust can be directly go to the beneficiaries, which can result in tax savings if the beneficiaries are in a lower tax bracket. So if you have bonds in these funds and generate dividends, you can put that dividends to say your younger children, and they're in lower tax brackets and they won't pay as much tax. The disadvantage is that you no longer maintain total control over your assets in the trust. The trust becomes a living being of itself, and you cannot use these for collateral as a loan, which is similar to the living trust as well, the revocable trust. Now, it's more expensive to set up. Usually even more expensive than some of the probate charges. And setting the trust can involve a lot of paperwork. These irrevocable trusts, something usually done for the ultra rich. I mean, you have $1 billion. You want this irrevocable trust. So um, some of these trusts can be created by a will. It can be activated after you die. So you can have a standard family trust, which sometimes known as the A to B trust, which can shelter. It's set up for tax purposes, really. So these are just different types of trusts that could be set up. And most people will do like a standard family trust, and there is this Q-tip, which is qualified terminable interest property. So this is gives individual establishing a trust the ability to direct income of the trust to other people in the family, usually their spouse. They're a sprinkling trust that distributes income according to need rather than a preset formula. So there's a lot of different things that it's just a legal contract. So most anything can be written up as far as directions or how the trusts are going to go, as long as the laws are followed for the trusts. Okay, so the last word on estate planning, basically, don't put this off. Many people put this off because it's complex, it deals with death. But I would say before you really have to seriously consider estate trust, estate planning, is two things actually three. I'll give you three factors. If you have over $1 million of assets, you should start considering estate planning. If you have children, you should start considering estate planning. And generally, if you're over 35, you should probably consider estate planning. And I would also say that you should you're going to need to hire a lawyer or professional to help you with estate planning. So you can hire a lawyer, but you can also hire other financial planning and estate planning individuals who are not necessarily lawyers, but they're expert in how estate planning works and how's the best way to establish this. And make sure your family knows where your estate planning documents are, who your estate planning lawyer is, what the trust formations are like. So the better informed they are, the more of a springboard they'll have to go and actually settle all your affairs upon your death. Okay, so that's the last word is death, and that's how we're going to end this chapter, which focuses a lot about what happens to you after you die. And this is the last chapter in this series. So I hope you enjoyed this series on financial planning and estate planning, and I hope it helps you to better understand these concepts. But this is just a starting point for you to really become more of an expert in these subjects. You need to do a little bit more self-study upon the particular areas in this series of lectures that interest you and it's something that you want to get more involved with. Okay, thanks for your time, and I hope you have a wonderful life.